Thanks for tuning in to Alpha Moguls. My name is Neeraj Shah, and with me, a special guest to talk about all that matters for the market, Swanand Kelkar of Morgan Stanley Investment Management. Swanand, so good having you yet again on Alpha Moguls. Thanks so much for taking the time out.
Thank you.
So, worried or sanguine about the prospects? Because it doesn't seem like it's an India-specific problem. There is an EM-specific problem by and large, which is gripping almost all EMs across the world. Add to that, the trade spat is not doing us any favors.
Sure. So, so I think if you looked at the India performance for the past 9 odd months, 8-9 months, there have been two phases, right? The first phase of the first 2-3 months was when India materially underperformed EM. And it is only around the time that the discussions around the trade war started heating up. Around that time, India started picking up a bit in terms of the relative performance against EM. And if you look at it now, India is outperforming EM by almost 5-6% in US dollar terms. So the narrative there seems to be that India is relatively insulated from the trade war narrative which is taking shape versus some of the other EMs, and has a fairly good domestic growth story going, right? I mean, that seems to be borne out by a lot of high frequency indicators. Even the GDP number, if you adjust for a 2-year CAGR, given that the base was weak, etc., seems to show that there is a fairly good domestic story which seems to be fairly strong, which is what is attracting attention towards India. So even if you look at it from a float standpoint, the FII flows were steeply negative for the first 2-3 months of the year. When I last checked them, they were like marginally negative or just about. So that turn has happened intra-year in terms of India's relative standing within the EMs. Having said that, if you look domestically, the 3 macro factors that we talked about, right, last time we met, and we had called it at that point in time that peak macro is happening in India, and this we said in late 2017, where the 3 indicators, which is inflation, current account deficit and fiscal deficit, were going to deteriorate from here. That was the view that we had last year, and that doesn't seem to be stabilizing as of now, right? I mean, if you look at any of these 3 metrics, inflation is clearly above 4%. Even if you look at RBI's forecast for the second half of this year or early F20, there's 4.7 to 5% in that range. So the debate on monetary policy is when is the next hike, right? But that word hike, it's cemented, right? So is it now, is it later? That's the discussion. With oil at 78, I think the inflation and the current account deficit problems are clearly there. They haven't gone away. And on the fiscal side, you can look at it from 2 standpoints. One is, the positive way of looking at it is that you can say that despite this being an election year, there has been a reasonable amount of fiscal discipline which has been followed in terms of not letting the deficit blow out. That's the positive way of looking at it. But the negative way of looking at it is that you have had a oil-related tax collection windfall from 2015 to 2018, when you could hike the excise and other duties on petroleum products and shore up the revenue numbers. That won't repeat. It's unlikely to repeat. And despite that, your fiscal deficit numbers are still flattish, right? That's a negative way of looking at it, that you were not able to capitalize on that windfall by reducing the fiscal deficit. And when that windfall is not available for the next, let's say, 2-3 years, does the deficit slip back? So on all these 3 parameters, I think the narrative hasn't improved. And I had hoped that this would be stabilizing a bit by now. It's not 2013, right? I need to be absolutely clear here. I think that is clear. I think that part is now clear, that this is not 2013. The markets are telling you that the levels at which they were. I mean, I remember August 2013, it was a nightmarish month.
Sure.
So again, to give a simple answer, short answer to your question, I would be slightly cautious here because the environment is not very conducive given the multitude of macro factors which are playing globally, right? Be it the trade war, be it the dollar strength, things like that. And within India, while the domestic story seems to be strong, for India to really do well or be confident, I think some of these macro indicators need to stabilize, right? I mean, I would want to see a couple of months when neither oil nor rupee makes the headline. Well, I think you get those 2 months, that is when I'll get a bit more constructive.
Yeah, but let's work with an assumption that both of those are beyond our control any which ways, and therefore parameters that we can't quite predict. If indeed they stay worse off or do not improve materially from here, but the micro is showing what it is showing and which is improvement, does that provide a downward cushion, aided of course with the strength in domestic flows, which thus far seems to be okay? Do those two yardsticks help cushion any kind of major downfall if it were to come about?
Okay, so the strength of domestic flows, I think, is a good trend. I mean, I'm extremely happy about the fact that those numbers have remained positive despite the fact that markets have been what they have been. So it's a very weird market, right? I mean, we are talking as if the markets are down some 10-odd%, but the markets are at a new high. But these are different markets. These are not the roaring bull market kind of a high. This is a uneasy high, right? Where not everybody is kind of saying that, because this has been led. It's a very narrow market. It's been led by very few stocks, etc. So to answer your question, does it provide a cushion? I think the domestic growth story provides a cushion, but it provides a cushion you have to always keep in mind versus expectations. Right, so if you have an F19 or an F20 EPS growth number for Nifty and let's say MSCI at 20 plus, right, the cushion is provided if those numbers are met. Right, it's already in the numbers. Right, I mean that you are trading at 20 PE on a 20% earnings growth number. That has to come through. I'm not a big fan of looking at market-wide earnings numbers. Because there are idiosyncratic factors which kind of, one big bank reports a big provision number or one oil company reports a big inventory gain or loss, and those numbers kind of go up and down. But yes, I think for the markets to remain here, this domestic story has to deliver. Right? If there is even a slight weakness there in the second half of the year or whatever, for whatever reason, I think it will be difficult for the markets to hold here, especially given the fact that the market rally is a very concentrated, a very narrow rally for now.
Yeah, well, let's wait and watch. Very interesting conversations now with some of the economy-facing sectors seem to suggest that they believe that the demand is strong. We were talking to India Cements, and he was talking about going back to 2005, that kind of a demand, saying people are just gobbling up cement, which arguably points towards infrastructure projects on a bit of a roar. And thus far, consumption and finance did that. Now maybe infrastructure comes to the fore as well. Swanand, the key question would be, how would an average person then have his portfolio? I remember a very important or a very interesting point that you made the last time, that people don't trade the index. People don't own the Nifty in their portfolio. They own specific stocks in their portfolio.
Yes.
Now my question is, does your portfolio construct, if you had the leeway to do that, change materially from what it has been in the last 9 months, 12 months, 15 months, in that you also keep some room for cash anticipating a correction, whether led by global factors or due to domestic factors, like the elections, for example?
Absolutely. So maybe a couple of things. I'll first talk about the infrastructure piece. I mean, having spoken to a lot of cement companies, of the three metrics that matter for a cement company, which is volume, price, and costs, the one metric on which every cement company unequivocally for the next 12 months or so seems to be very confident is volume. Right? I mean, everybody seems to be telling me that double-digit volume is a given. And it's primarily being led by infrastructure projects, as you said. This could be a rush ahead of a busy election schedule to get stuff finished. So the question that I have not been conclusively answered is this a 12-month of frantic activity and then then things kind of cool off a bit? It's a question I don't have an answer to, but as of now, you are right. The volume growth story is really strong. But the only thing on making a broad comment on infrastructure, I would say, is that still public expenditure. Still, that's the only piece which is driving the infrastructure rather than anything else. And the difference versus 2005, 2006, 7, as you mentioned, is that the buyer in that cycle was probably a dispersed buyer. Because you had housing doing well, you had private capex doing well, you had even the public expenditure doing well. This time around, it is probably one large disproportionate buyer for cement companies, which makes the pricing equation a bit difficult to negotiate. Right? In a diffused buying environment, you can raise prices easier. In a single large dominant buyer, raising prices is not as easy as it is in a diffused environment. That's the only point I would make there. But I agree with you that the volume growth there is really strong. So how do you construct portfolios? So I'll give you two approaches to it. So one approach is a macro top-down approach, where you can say oil at X, rupee at Y, hence current account deficit here, inflation here, fiscal deficit here, hence external facing sectors, and you go overweight tech, pharma, you take a broad top-down view, align your portfolio into this pocket of the market, and say that okay, I'm going to stay away from the remaining part. Right? The other view is these same factors stay here or reverse from here, in which case inflation cools off, in which case you get a benign monetary cycle, in which case cost of funds goes lower. You buy wholesale funded financials, right, who get money from the wholesale market. I'm telling you the extreme ends of how you can construct a macro portfolio from pretty much one variable, right? You can, which is oil price, right? You can just, but I think that's a very short term, at least from my standpoint, it's a very short term way of constructing portfolio. This portfolio you are constructing to outperform over the next 1, 2, 3 months, and it's always a difficult game to play. The way I have constructed portfolio, I have looked at portfolios is to look bottom up, to find 15% earnings growth, 15% ROE that we discussed the last time, and not look for sectors or not look to make macro calls, right? I mean, I haven't, okay, let me put it this way, the biggest mistakes I have made in the past maybe 5, 6 years have been when I have made pure macro calls, right? Saying that I think rupee is going to X, I think that the corporate asset quality cycle is over. When I made those calls, I think that is when the transmission into specific stocks hasn't been as strong. So I still stick to my bottom-up way of investing. I still find that domestic sectors growth is fairly good. I'm finding 15% growth, 15% earnings opportunities in those spaces. The only change from the last time we met is we have reduced our underweight in tech. We were deeply underweight tech. We have reduced that underweight over the past 6 odd months. And the reason there is simple. The original thesis was that 2018 or FY19 from a top line growth standpoint is better than FY18. That is clear. But I think there are some companies now, especially on the mid cap side, where I am able to convince myself that they are meeting my 15% growth bar. And as facts have changed, I have changed my opinion, and I have added to some technology names, but this is not a rupee driven decision. This is this is a decision driven by the fact that 6 months ago I thought a company X was going to grow top line 9%. I think it's now going to grow 12-13%. The rupee will obviously help margins and hence a better EPS outcome, and those are the kind of companies that I have engaged in where there has been a fundamental change in what I assessed the business dynamics to be. So that's, I wouldn't say wholesale. Again, we are still underweight tech, but we have reduced the underweight because I don't think this is a widespread acceleration or an acceleration to the way we saw in 2009-10. Right? This is an acceleration for sure versus last year, but it might be 2-3 percentage points. But within that, there are winners to pick.
And naturally, by the definition of that 15% growth numbers, you're looking at mid-cap tech. Large cap tech, there's probably one name, if at all, which is talking of growing at 15%.
Absolutely. So between those names that you mentioned, a few mid-cap names, some large cap names which could meet that number is where we have moved to. But I still keep the portfolio. The portfolio is still extremely biased towards domestic growth names. That's how I have stuck through these. I feel the market has in a way taken the top-down view of investing. If you look at the sectors which have done well over the past 8-9 months, it's information technology, consumer staples, those have done really well. This reminds me a lot of 2013. So if you think about 2013, IT did really well. It was pharma which also did well at that point in time. Again, exporting sector and staples. And everything else was kind of underperforming. So it's like a 2013-ish reaction that the market has taking a very top-down view and buying labels. Right? You buy consumer staple is a defensive label. It's a defensive sector. So you bought the label. You have not bought the underlying business fundamentals. You bought the label, and that is what has happened. Which I feel, as and when it reverses, and you remember 2014. As and when it reverses very, very sharply.
Yes.
So as I said, what is my dream scenario for the portfolio? That oil and rupee are not in the headline for 2 months. Right? That is the ideal scenario for the portfolio that I'm running today.
Interesting. If I may, now there are two ways of having caution in your portfolio. One would be buying those labels, defensive labels, because they would not fall as much, presumably not fall as much. The other one would be a slightly more extreme one, which is to sit on a bit of cash. Now, you as an institutional investor may not have that leeway, but if you as a personal investor had that leeway, would you take that call? Sit on some percentage of cash to be deployed a bit later on when the opportunity arises?
As a personal or a professional investor, I've rarely taken cash calls. But what I have, my adjustment filter there is how ticklish I am on valuations. Right, rather than taking a cash call, I tighten my valuation metrics or valuations that I look at to provide for some cushion, some margin of safety. So in a go market, I might loosen it a bit. In a market like this, I want to be extremely sure of what I'm getting into. And to get into those kind of stocks, it means that you have a temporary amount of cash, so be it. But I have not taken a cash call saying that I want to sit on cash. In a big way. So I'll give you the math, at least institutionally, how it works. Right? If you take a 10% cash, which is the maximum cash that you're allowed, and the market corrects by 10%, right, which is from today's levels goes down to 10,700, 800, you make 1% alpha, right? 10% into 10% cash. It's not a big number. I'm not as certain that this is going down 10% for me to make that kind of an alpha. So I have refrained from taking cash calls, because on an overall balance, these things even out. So I would rather tighten my valuation parameters. I'd rather tighten what gets into the portfolio rather than taking cash calls.
Okay. One space that you track very closely, I know personally, and that's autos. Now, they used to be high frequency indicators, used to do very, very well. Of late, there is a bit of a chalk and cheese behavior arising within this pocket as well. Tractors have done well. CVs you could question here and there. The numbers by and large seem to be okay. Two-wheelers, that whole margin pressure because of Bajaj Auto's call is right out there. What do you do henceforth? Here on for the next 12 to 18 odd months, with a presumption that rural income goes up, etc., because of MSP and all of that, an election year, and therefore that whole spending continues. How do you play auto?
So I'll tell you about the three segments that you talked about, right?
Or four or five, whatever.
So commercial vehicles is a space that we have engaged in, we remain engaged in. I think after the July and the August volume numbers, I think that overloading restrictions which were removed, I think that issue has been addressed, is what I feel. Just as the cement guys are telling you that there is roaring demand, there are the trucking guys, the CV guys who are telling me that the demand for CVs is really strong. It's evident in the volume numbers. Freight demand is running fairly strong, and that's for things like tippers, which are related to what you're seeing on the infrastructure space. On passenger vehicle space, is pretty much one company that we are talking about, and we remain engaged there. And this is not so much a call on the passenger vehicle growth as it is on the industry, the very, very attractive industry dynamic that you have in India, that there is one car company who has a market share comfortably in excess of 50% and probably has no incremental competition left to come because everybody has tried their hand here. Think about the last couple of years and name a non-50% guy model doing really well. You'll probably name one or two.
Yeah,
right?
One unlisted, if I can.
Exactly. So basically, the top 5, top 7 selling cars in India belong to one company. So even if the passenger vehicle growth is single digit, I'm confident that the dominant market share player will have 2x that growth, and possibly the remaining industry will be flat. So that is the call that we have made on an industry structure more than the passenger vehicle growth itself, which remains okay, which remains a fairly decent number. On two-wheelers.
By the way, before we get to two-wheelers, just a follow-up on that. Somebody that I was speaking to yesterday on the future of the car industry, and with a presumption that autonomous driving or aggregation driving is going to become bigger, and God knows Uber and Ola have set that stage, which means that the car industry moves from being largely or majority B2C to an extent moving B2B as well, right? And in a big way. Does that also set the stage for a low-cost dominant player to extend its strength and dominant position?
Absolutely. So if you if you look at, these numbers are not there in the public domain, but the cab aggregators, their contribution to PV sales, I think peaked in FY17.
Peaked in FY17.
Peaked in FY. As a percentage of the total passenger vehicles, what percentage was with the cab aggregators? What percentage of sales were made to them? That number has come off a bit in 2018, FY18, as you tried to shore up your P&Ls as cab aggregators, either induced by private equity, or you wanted a next round of funding, or you had some issues happening at the mothership, etc. And the profitability for the individual cab drivers not being as great as it was, let's say, when you had all these stories, right?
Sure. 80,000 lakh to
exactly.
a
Uber guy telling you that making a lakh rupees a month, you felt like quitting your job and driving a cab. But that is behind now. So this is a trend which will continue, but I think it has come off its peak. And yeah, I mean the car of choice there is a car which will give you the best economics, right? Because this is a commercial venture. This is not a pleasure, or this is not a personal venture. So if it is a commercial venture, you will think of that buying a car in the same metrics or in the same framework as you would think of buying a commercial vehicle, right? Which gives me the best mileages, which gives me the best return. So that is what will drive that decision there. And if your car has that kind of mileage kitna deti hai, I think that's the way it will go.
Interesting. Okay, Swanand, now I want to talk about a larger piece, and which is the financial super cycle, as a lot of people like to say, and how does one do that? But just before I get to that in a meaningful way, I know it's difficult to hazard a guess as to what's the kind of correction that could come in. But if a correction were to come in, as things stand right now, and as you see things right now for the markets at large, either driven by the global factors or because of the local factors, elections thereof, so on and so forth, do you expect a steep one, or do you believe that because of the growth momentum within the economy, it will be bought into and therefore largely could be a shallow one? The best guess right now.
Sure. So I would say an idiosyncratic correction, which is an India-only correction, is unlikely to be very deep. If you get a correction which is emanating from global factors, right, emanating from a global scare about something, it's very difficult to hazard a guess on what kind of a correction you will get because of those factors. So I think that's where I stand at, because the macro factors which I'm talking about are well telegraphed. It's not as if people don't know them. Everybody has done the sensitivity of oil at 80 means what for CAD and what for fiscal deficit. So it's out there. It's not unknown. So I think the India-only and idiosyncratic India-only correction seems a bit difficult, a steep one, but a global markets-driven correction might be. You don't know how steep that is, but I still remember John Templeton's line, right? I mean, a lot of people have lost money waiting for a correction than in the correction itself. So I am not a big person to make. I'm not a person to make big market calls.
Yeah.
I've never really done that because that's not my forte. I mean, I know people, I know friends who have a great sense of the market. I don't have it. I'm quite clear about that fact. That I don't have a sense of the market. I mean, I would rather spend time analyzing companies and sectors and react to prices rather than spend time thinking a lot about this looks overextended, this is looking extended on the chart. Not that it's incorrect. It's not my forte. That's not what I have done. That's not what I'm good at. So why dabble into things that you're not really good at?
Okay, let's dabble into things that you are good at. One of the interesting pieces that you wrote, and while now largely an open secret, but still deserves a mention because it's a far cry from what we as Indians have been used to all through our lives. And that line was very catchy. Loan pay phone, phone pay loan, something that you saw.
Yes.
And the financialization, if I can use that term, of almost everything that we can think of.
Yes.
The lending super cycle. Where are we in that lending super cycle currently? Do you believe we're at the onset? Do you believe we're midway through what is largely looking like getting to maturity super cycle? Or do you believe that for now we are pricing in this change quite adequately?
Okay, so in terms of where we are on that cycle, I think we are getting started out. I don't think this cycle has matured. And why do I say that? If you look at metrics like India's household debt to GDP, what percentage of two-wheelers are sold on finance, etc., I think that is just about starting out, maybe 2-3 years. If you look at what kind of loans are being extended by banks in these spaces, I think we're just getting started. But this is a trend, and I mentioned that in the piece which I wrote as well. This is a trend which can get overextended very quickly. I remember meeting a financier in the 2006-7 cycle who was lending unsecured. And I asked him what is the criteria for lending, and the answer I got was traceability. Right? I should be able to trace the guy who I have lent to, and if I'm sure of that, I'm going to lend, and that scared me. Right? I mean, traceability cannot be a criteria for lending. I think the industry has come a whole way over the last 10-12 years from traceability being a criteria. I mentioned this example in the piece that I wrote, that if you remember in 2006-7, you came out of the airport, if you had an economy class boarding pass, there was somebody standing outside to give you a credit card, handed over that pass, you got a silver credit card. If you had a business class business class boarding pass, you got a gold credit card. So it was a very surrogate way of lending. What has happened in the last 10-12 years is that this has become a bit more, I would say a lot more scientific, right? You have credit information bureaus which are now able to give you information on your borrowing history. There are institutions, banks, NBFCs, etc., who are now tapping into the data of their own customers much more effectively than what they were doing earlier. So thus far, I think this cycle seems to be on a good footing, and evidenced by the asset quality numbers segment-wise that we get from some of the independent data providers. This cycle has legs to run, but I will watch this very keenly in terms of, I'm not saying this time is different. I'm saying that this time it's the same. But the thing is, we are just getting started out on this cycle, and there are enough legs to run still for it, but you'll have to keep watching some of the signs of overextension very closely.
Okay, so is it because largely all the incremental credit growth has been retail-led, and that's why is it a sign of maybe getting in the overextension space, or as the bear would say, it's already looking overheated?
Sure. So retail being incremental, bulk of the incremental credit is not retail getting overheated, but that other parts of lending not doing too much, right? Agri, corporate, etc. Are flattish. So if you look at the retail loan growth numbers, those by themselves are in the 18 to 20% YOY growth range, which I don't think you would call them overextended for an economy which is growing nominal GDP by 12-13%. It's the other parts of credit growth which are not growing as fast, which is making retail stand out in terms of its contribution to the overall credit growth. So I wouldn't say that is getting overheated. You will always find pockets, right? Even at the beginning of any cycle, you will find pockets, and the naysayers will always point to those pockets. See, listen, here is this one affordable housing company whose NPAs have gone from 1 to 7, or here is this X company whose asset quality experience has been really bad. I would treat them to start with as isolated incidents. I would look for, is there a commonality? Are all companies in that sector reporting similar asset quality experience? If not, then you have to look for reasons which are more specific to what's happened in those individual places. But if you find that the entire segment, which happened in certain segments like LAP, right? If the entire segment is reporting asset quality issues, then it's a time to be cautious. But for now, there are a lot of NBFCs proliferating, which is what I get to see a lot. These are fintech enabled or tech companies, small ones, tech companies who are also lending, that kind of things. Watch that space very closely. As I said, right, this is good for now. It is extremely powerful. It is extremely easy to grow 20, 30, 40% here. But keep watching for the collectability. As one of the CEOs of an NBFC who I respect a lot said, the money is made in the last EMI. Right? The money for the bank or the NBFC is made in the last EMI. So see the ability to collect the last EMI. Right? See if that last EMI is coming through. So today the naysayers are basically the fear of unknowns and the older generation thinking that loan is a bad word and etc. etc. But I think we'll have to watch how the credit cycle pans out, especially in this space. But for now, I'm not seeing signs of overheating, no.
Swanand, always a pleasure chatting with you. Thanks so much for joining in today on Alpha Muggles and giving us your thoughts.
Thanks a lot, Neeraj.
And viewers, thanks for tuning into this leg of Alpha Muggles.